All right, hey everybody. Actually, we are talking specifically about Hewlett Packard HPQ, and from the you can see from the platform that it's looking pretty darn weak. It put in two highs, all-time highs, big rejection, and then we just got the crossover. So now we have the bearish crossover. We have the neural index that goes into the red, showing short-term strength, and we have all three predictive differences having a bearish slope, meaning negative slope, and the short term actually just went into the negative, or it's right at zero. So, and we are still here with the predictive high is 2408. So we're at the high end of this thing, but I'm not seeing a whole lot of bullish momentum. I mean, this looks pretty darn sick. So we can do one of two things. Well, we can do a number of things, but two things I'm considering. We can buy a put spread or sell a call spread. I think that for us to get any sort of premium, we're going to have to go out to next week and sell if we look at even selling a 24 half, 25 half, excuse me, 24 half, 25 half, that thing is not, we're not going to be able to pick up. Things trading 17 cents. You're laying more than 4 to 1. I'm not doing that. For the same thing, let's calculate what the expected move is supposed to be out through next week. And you guys know how to do that by now, hopefully. And if you don't, you can ask, or there are not all kinds, but there's videos in the documents tab. Okay, so with the underlying price of 24, we want to go out to 323, and then the implied vol for that 323 is 26%. So that is targeting to the downside. For full standard deviation, the 23 strike or the 24 strike, because I don't have a confidence interval in here. So obviously that confidence interval would be 0. I'm going to look at a 59% confidence interval. And we're looking at somewhere in the neighborhood of 23. 2297 on a full standard deviation, 2309 on a 59 percenter. So it seems like that is a decent place to start to look. Let's clear our sims. So that is going to be our target strike. Can we buy the 23.24? Be very simple with it. 23.24 is trading for 27 cents. We're sitting here right at the money. We can easily figure out what our reward to risk ratio is. We put in 23, 24. We want to buy this one, sell this one. We know that this spread will max itself out at 23, and we know that we're going to have to pay, let's just say, market is 21.34. If we pay 30 cents for this. If we pay 30 cents for this, we're getting 2.33 to 1. If we're paying 27 cents for this, we're getting 2.7 to 1. Not, really splitting hairs here. So I would put in probably paying 27 cents because it is rallying a little bit. And if it's going to do that, I want to have be paying a little bit less. But this seems reasonable. And if it turns around everything, we'll cut bait on it if we have to. But this seems like a decent reward to risk ratio. The curve itself is certainly, or the platform itself is certainly indicating down. And there just doesn't seem to be a lot of steam. It seems like the market is going somewhere. We just can't figure out where it is. But this being without, and then that gives us the chance to also, if we have a strong sell signal like that, well, then we can go out and we can look for something that maybe we want to do from the buller side. Okay, any questions on that before I put this signal out? If not, I'll get the video rendered and we should be good to go.